Have you ever wished to spend a quality vacation without worrying about your income, as you are getting paid even for enjoying it? This is something you get with dividend stocks. Dividend investing can be a very profitable investment strategy. Dividend stocks have traditionally outperformed the S&P 500 while experiencing less volatility. This is because dividend stocks offer two types of returns: regular income from dividend payments, as well as capital appreciation from stock price appreciation. Over time, this total return can add up. Due to their lower volatility, dividend stocks often attract investors looking for lower-risk investments, particularly those in or nearing retirement. However, if you don't know what to avoid, dividend stocks can still be risky. If you enjoy such content, then make sure to like this video, subscribe to our channel, and turn on bell notifications to never miss another upload of ours. So, let's learn how you can build a strong dividend portfolio in 2022. Let's dive in. What are dividends? Dividends are the one-time or periodic distributions to shareholders of a portion of the industry's retained earnings. These dividends are typically made in additional investment shares. A dividend will be paid for each share of stock, mutual fund, or ETF you own over the ex-dividend date. Companies pay earnings regularly. Dividends are sometimes paid monthly, quarterly, or even semi-annually, depending on the investment. Investors want to invest in dividend-paying assets for a variety of reasons. Some include consistent income, appreciation of underlying assets, the potential for an increased distribution with time, and tax benefit. Why should you consider investing in dividend stocks? Every investor dreams of accumulating higher returns and booking massive profits in the stock market. The primary goal of every investor is to profit from the increase in share value. However, that is not the only way to profit and make money in the stock market. Investing in dividend stocks has proven to be a good and simple way to generate a steady and consistent income stream. Here is why you should invest in dividend stocks. Firstly, it acts as a great source of passive income. As we know, that organizations consistently offers high dividend stocks and distributes its profits to all shareholders. This provides them with a consistent source of income, similar to the interest they would receive if they saved money for a longer period. Just as a band provides guaranteed returns on investments, dividend stocks provide guaranteed returns to ensure that money is invested wisely. Secondly, they are less risky. High dividend stocks retain their value, even if the market crashes or a specific event declines. As a result, they are less risky than other growth stocks. The best thing about dividend stocks is that they regain their value during volatile market movements, making them a reliable option for capital protection for risk investors. When these stocks are added to a portfolio, they effectively diversify the risk potential. Next, it helps you reinvest the dividends. Investors who receive dividend payments can use them for personal expenses or reinvest them in the same stock. Using dividend payouts to reinvest in the same stocks can help investors deliver consistent returns on their investment, thanks to dividend compounding. Investors regularly reinvest dividend payouts in the stock market can boost returns. They are less susceptible to market volatility. With dividend stocks, investors do not have to devote their entire time and energy to tracking stock movements or other market movements. Dividend stocks are very strong and stable companies that are less prone to market volatility and have fewer price swings. To begin investing in dividend stocks, all an investor needs is a simple buy and hold strategy. How dividend stocks work? Consider the following example. Assume you purchase around 100 shares of a company for $10 each, with each share paying a $0.30 annual dividend. If you invested $1,000, you would surely receive $30 in dividend payments in a year. That implements out to a 3% yield, which isn't bad. It is entirely up to you what you do with your dividends. You can reinvest them to buy more company stock, purchase stock in a different corporation, save your money, spend the cash, etc. You can do with dividend stocks. Irrespective of whether the organization's stock price rises or falls, you will continue to receive dividend payments until the organization continues to pay them. The beauty of dividend-paying stocks is that they include predictable quarterly payments as your return. Unfortunately, as the COVID-19 pandemic has demonstrated, not all the organizations offering dividend stocks are able to maintain a dividend payout in all economic environments. However, a well-diversified portfolio of your dividend stocks can generate consistent income, rain or shine. When you combine dividends with their capital appreciation, as the value of the organization you own will rise, your total returns can rival, if not exceed, those of the broader market. Who should think about buying dividend stocks? Investing in dividends is safe, but investors should not take it lightly. Compared to other investments, this method necessitates extensive research and time. However, before beginning to invest in dividend stocks, one should fully understand the benefits and drawbacks and whether it is a suitable investment for their budget. Dividend stocks are less risky than non-dividend stocks. However, before incorporating dividend investing into an investment portfolio strategy, an investor should become acquainted with the benefits and drawbacks of dividend investing. How to build a dividend portfolio for 2022 and beyond. Incorporating these features into your investment strategy when developing your dividend portfolio for 2022 and beyond is beneficial. Mutual funds or ETFs versus individual stocks. You can diversify your dividend portfolio by investing in stocks, mutual funds, or exchange-traded funds. Each has its own set of advantages and disadvantages. For example, individual stocks allow you to choose which companies to own and sell. Furthermore, you can time your purchases to ensure that you receive qualified dividends. Mutual funds and ETFs provide instant portfolio diversification, as well as professional management that selects individual companies on your behalf. In addition, because these funds regularly buy and sell stocks, you may receive a mix of qualified and non-qualified dividends as well as short and long-term capital gains through no fault of your own. Retirement account versus taxable account. You don't have to worry about the tax status of dividends when you invest in them through a retirement account. However, when using a taxable brokerage account, try to time your purchases so that your dividends are qualified. Long-term capital gains are taxed at the same rates as qualified dividends. Dividend portfolio sector investing. Some industries pay higher dividends than others. Historically, utilities, telecommunications, and consumer staples have provided the highest dividend yields. On the other hand, small company stocks and technology companies tend to reinvest their earnings to grow revenues. So many of these companies do not pay dividends. Or if they do, the average yield is much lower. Inflation's impact on your dividend portfolio. One major risk to be aware of as you build your dividend portfolio is the impact of inflation. Inflation devalues your earnings and reduces your purchasing power over time. This is why choosing companies with a track record of increasing dividend distributions faster than inflation is critical. For example, if you have $100,000 in a dividend portfolio with a 4% dividend yield, you will receive $4,000 per year. However, with a 3% inflation rate, goods and services will be 50% more expensive in 15 years. Therefore, if your dividend distributions do not keep pace with inflation, your ability to pay your bills and enjoy your lifestyle may suffer significantly. Track record of consistency. Look for a consistent track record of dividend payments when evaluating potential investments for your dividend portfolio. A company that consistently pays its dividends is often a better choice than one that has started and stopped payouts several times. Furthermore, companies that increase dividends regularly can help you keep up with inflation and increase your income. Diversification. Don't forget to diversify your investments as you build your dividend portfolio. Concentrating your money on one stock or sector can significantly increase risk in your portfolio. Mutual funds and ETFs automatically provide company-level diversification, but they can still be concentrated in a specific geography, sector, or asset class. What are some of the best dividend investment strategies? The widespread misconception is that dividend stocks are appropriate for retirees as well as risk-averse investors. That is not correct. When investing, consider buying yourself dividend-paying stocks to reap the long-term benefits. Dividend stocks, particularly those in the organizations that raise their dividends regularly, have traditionally outperformed the industry with lower volatility. As a result, dividend stocks are a good fit for various portfolios because they will help in building a diverse portfolio. There are several dividend strategies to think about. The first step is to incorporate a dividend portfolio into your overall portfolio. When constructing a dividend portfolio, keep in mind that companies are not required to pay dividends in the same way they must pay interest on bonds. The dividend may be jeopardized if a company's expenses must be reduced. The risk of a dividend cut cannot be eliminated but can be reduced. First, consider a company's ability to increase its dividend rather than its dividend yield consistently. Next, you could look for a firm with a strong financial profile focusing on a developing industry. Determining how you desire to reinvest your dividends is another aspect of a dividend investing strategy. Some investors prepare to manually reinvest their dividends, while others utilize a dividend reinvestment plan, also known as a DRIP. Moreover, this powerful device will reinvest every dividend you make in that company's stock without fees or any commissions. This incredible set-it-and-forget-it tool is one of the simplest ways to harness the power of time and compounding value. Another dividend investing strategy here is to invest in a dividend-focused and exchange-traded fund, as well as a mutual fund. Investors can own dividend stocks diversified portfolios, generating a passive income through these fund options. Adding dividend stocks in your dividend portfolio can be highly beneficial regardless of your dividend strategy. They will surely help reduce volatility and increase total returns, allowing you to reach your financial goals more quickly. Creating a dividend portfolio is an excellent way to generate consistent income. This strategy allows you to earn money consistently, while also participating in the growth of the underlying stocks and potentially benefiting from tax breaks. Whether they are aggressive or conservative investors, investing in dividend stocks can provide decent long-term returns. However, before investing in high dividend stocks, it's always a good idea to do your research. This will assist them in ensuring that their investment capital is in the right place and provides guaranteed steady returns. Let us know your views in the comment section below. Also remember to subscribe to our channel to never miss out on more videos like this.